Volkswagen has officially ceased all sales and operations in the United States, ending nearly 70 years in the American market. This isn't just about one company, it's about jobs, the economy, and the American automotive landscape. The German auto giant, known for the Beetle and Jetta, cites insurmountable regulatory pressures and a strategic shift to other markets. The decision was abrupt, leaving consumers, employees, and analysts scrambling for answers. Wall Street felt the shock immediately, with trading halted for major automotive stocks. Volkswagen's statement blamed rising costs of federalizing new electric vehicles and fierce competition, but experts say the story runs deeper. US car sales were already cooling, and this could trigger a deeper freeze. For generations, Volkswagen was more than a car brand. It was a symbol of German engineering and counterculture spirit. Last year, VW sold over 375,000 vehicles in the US. Their sudden absence leaves a massive vacuum. The impact stretches from factory workers in Tennessee to car buyers in California. Government officials are holding emergency meetings, and the United Auto Workers Union calls the move a betrayal. This is a complex, unfolding crisis with economic and social consequences. We'll break down what this means for jobs, the supply chain, car prices, and consumer confidence. Volkswagen's exit is a stark reminder of the fragility of our global economy. The real-world impact of this corporate decision will be felt for years to come. The most immediate impact of Volkswagen's exit is on its American workforce. The Chattanooga, Tennessee assembly plant, once employing over 4,000, now faces a complete shutdown. These are families facing an uncertain future, as the plant was a cornerstone of the regional economy. For every direct job lost, up to 10 more in the community are at risk: parts suppliers, logistics, local businesses. The University of Tennessee project's local unemployment could triple. The loss isn't just paychecks, it's the threat of a long-term regional recession. Corporate and administrative jobs at Volkswagen's U.S. headquarters in Virginia are also vanishing. Severance packages offer little comfort to highly skilled professionals, now forced into a tough job market. The Department of Labor is deploying emergency support and retraining resources, but the challenge is immense. Retraining specialized factory workers is costly and time-consuming, with skills not easily transferred. This is one of the largest auto sector layoffs in over a decade. The human cost is immense, a loss of talent, expertise, and stability for thousands of American families. The story of these workers is the human face of a global corporate strategy shift. It's a stark reminder of labor's vulnerability in a globalized marketplace. Volkswagen's U.S. operations were the hub of a vast supply chain, now thrown into chaos. Hundreds of suppliers across North America face catastrophic losses, with investments in VW-specific tooling now worthless. The Center for Automotive Research predicts at least 50 major U.S. auto parts suppliers are at high risk of bankruptcy within 6 months. Many suppliers, especially in Michigan, Ohio, and Indiana, relied on VW for over half their business. The domino effect threatens tens of thousands of jobs and could topple a significant portion of the domestic parts industry. Just-in-time manufacturing is exposed as a vulnerability. Suppliers are left with useless inventory and idle lines. Larger companies may acquire failed competitors, but many will not survive. The crisis isn't limited to VW-exclusive suppliers. Shared suppliers could create bottlenecks for Ford, GM, and others. If a key supplier fails, it could halt assembly lines across the industry. Volkswagen's exit is a major tear in the fabric of North American automotive supply. Over 600 independently owned Volkswagen dealerships now face an existential crisis. Franchise agreements are void, and millions in new car inventory can't be sold as new. These dealerships, pillars of their communities, must liquidate assets and lay off staff. Family-owned businesses, some for generations, are unraveling overnight. Service bays staffed with VW-trained technicians lose their primary function. Over 30,000 dealership jobs are gone, with many technicians struggling to find equivalent work. Skills are often brand-specific, making retraining difficult. VW owners now face uncertainty. Where will they go for warranty work or parts? The trusted dealership network is being dismantled, complicating service and repairs. Independent shops may fill the gap, but delays and higher costs are likely. The collapse of the dealership network is a direct blow to local economies and VW customers. The ripple effects will be felt in communities nationwide. The halt of new Volkswagen sales will shake up the used car market. With 375,000 new VWs removed from annual supply, prices for used cars, especially sedans and SUVs, will spike. Consumers seeking new VWs will turn to alternatives, driving up prices for used Hondas, Toyotas, and Hyundais. Current VW owners may see their car values soar in the short term, as scarcity makes late-model VWs highly sought after. Manheim projects a 15–20% spike in used VW values this quarter, but this won't last. Long-term, lack of support and parts will erode value. The orphan brand effect will tarnish VW's reputation for reliability. Used VW values will peak, then decline as ownership becomes riskier. The winners, current VW owners looking to sell. The losers, budget car buyers facing higher prices across the board. Volkswagen's exit makes affordable used cars even harder to find for American families. Volkswagen's exit leaves a power vacuum, and competitors are moving fast to fill it. Brands like Honda, Toyota, Hyundai, and Kia are poised to absorb VW's market share, targeting former VW customers with aggressive marketing and incentives. Expect special financing, loyalty programs, and digital ads aimed at VW owners. The competition will heat up in compact sedans, SUVs, and electric vehicles, segments where VW was strong. American automakers like Ford and GM may see a modest boost, especially in models competing with the Tiguan and Atlas. The exit also removes a key rival in the electric vehicle space, benefiting Ford's Mach-E and GM's EVs. But a sudden surge in demand could strain competitors' production and supply chains, risking shortages and price hikes. The scramble to capture VW's share will test the agility of every automaker in the US. The next year will be defined by this race, and by how well competitors can meet new demand. The industry is bracing for a period of intense competition and rapid change. Volkswagen's exit isn't the first. Isuzu and Suzuki left the US market in the last 2 decades. Both struggled with dwindling sales and competition, leaving owners and dealers in limbo. Suzuki's departure showed how orphaned brands face rapid depreciation and service headaches. VW's scale, however, is far greater. Its exit is a tsunami, not a ripple. The Chattanooga plant closure alone dwarfs the total job losses from Isuzu and Suzuki combined. History shows the market will eventually rebalance, with competitors absorbing VW's share. But the transition is painful for owners and workers left behind. The key lesson, how VW handles parts, warranties, and support, will shape its legacy. The market adapts, but trust and value for orphan vehicles are hard to restore. Managing this transition is critical for consumer confidence and the brand's reputation. Volkswagen's abrupt exit inflicts a deeper wound, a crisis of trust for American consumers. Buyers expect manufacturers to support their vehicles for years. VW's departure shatters that confidence. This sends a chilling message. Even global giants can vanish, leaving customers stranded. The ripple effect may push buyers toward larger, more established brands, hurting smaller players. Consumer confidence, already fragile, could take a hit, delaying big purchases and fueling economic anxiety. VW's global reputation is damaged. Abandoning the world's biggest market won't be forgotten. Rebuilding trust, if VW ever returns, will be a monumental challenge. The message in today's market: even icons aren't immune to sudden disappearance. Volkswagen's departure marks the end of an era and the start of profound change for the US auto sector. The immediate fallout: thousands of jobs lost, supply chains disrupted, and local economies devastated. The used car market is in chaos and competitors are scrambling to fill the void. The human, industrial, and consumer costs are immense. History shows the market will rebalance, but the pain will linger for workers and owners. The industry faces a historic transition to electrification and autonomy, an expensive, risky evolution. Volkswagen's exit is a warning. Even the biggest players aren't safe from industry upheaval. The question now, will this be an isolated event, or the first sign of a larger, more brutal consolidation to come?